Hey everybody, we're back, and today I want to look at something very interesting. About 2 weeks ago, the president signed and assented to the Banking Amendment Bill 2015, and so I'd just like us to look at what does that mean for us. So stay tuned. This is MoneyWise with Rina Hicks, where we create, grow, and preserve wealth. There's been lots of discussions about this interest rate capping that has been as a result of the Banking Amendment Act, or rather Amendment Bill 2015, and I wanted us to understand a few things and just see what implication then does it have on us as individuals, on the banking sector, and generally on the economy. Before we get into that, I want us to look at what is interest rates. When you pay an interest rate in your bank when you've taken a loan, or when they give you an interest rate, what are we really talking about? And the interest that I want to look at is interest that you incur when you take a loan. Now there's something that we need to appreciate, and that is the interest that a bank charges you is not a random number. It's not a random number. The bank takes time to think through a few things. One of the things they need to take time to think through is the cost of funds. How much is that money they're lending you costing them? Because most of these banks have to borrow this money from somewhere. They either borrow it from another financial institution, or they borrow the money from lenders or depositors rather. So when you take your money to the bank and you open a savings account, effectively you're lending your money to the bank and they'll pay you an interest for that money. So they have a cost, and that cost is what we call the cost of funds. So there's cost of funds, and then above that cost, there's a cost of administration. So the admin cost means when the bank takes your money, they have to deploy it, they have to employ people, they have systems to pay for, they have IT systems to run, they have rent to pay, and they have expansions to do, and so there's a fee that they incur in the normal cost of running their business. The third thing that goes into that is what we call non-performing loans. You know, when you go and take a loan, the bank looks at your history, it looks at your current cash flows and the potential that you have to either repay or not repay. But the reality of the situation is a certain percentage of those who borrow money from the bank will actually not pay. And so they have to price in that risk and what we call non-performing loans, because some of the loans that they lend will become non-performing or become bad debt. And so they price that into the interest risk. Now the last thing, because they're in business, they have to make a profit. So the profit is the last thing now that they add to then now determine what margin do they need to charge that will take care of the cost of funds, the administration of those funds, and non-performing loans, as well as make a profit. Now the thing that we also need to appreciate is the banks are different. And what does that mean? These banks that are bigger, they're multinationals, and so they're trusted, and so when they want to get deposits, it's easy. It's not so difficult. I mean, if you hear the name Barclays or you hear the name KCB, you know, there's certain confidence that goes with those names because they have huge balance sheets. Standard Chartered, you know, it's international, and that's so on and so forth. But when you come to the smaller banks that are locally owned, or, you know, perhaps only in the region, not very big, small balance sheets, have been in existence maybe 2-3 years or 5-10 years, you're not as confident as you are with a bank that has been in existence for 60 years, for example. So the smaller banks will have a more challenging time trying to raise capital or to raise money to be able to on-lend to others. So they'll pay a higher cost. And that means, for me, if I'm taking my money to a smaller bank, I'm going to demand that my savings account gives me more interest for the risk that I'm going to have to pay. So the cost of funds for the different banks is different. And so that's why some lend at a higher fee than others. So I felt it's important for us to appreciate that it's not the same playing field for everybody, because it depends how long has this bank been in existence. And when I say bank, I mean financial institution that is deposit taking, whether it's a microfinance bank or a regular commercial bank. I mean, it's different for them depending on their size, depending on their clout, depending on how long they've been in existence. And so it's important that we just appreciate that as we look into how will this interest rate capping affect both them and us. So now hopefully we know that interest rates are not just plucked from the sky or from the trees. There's a formula that goes into determining what interest rate a financial institution will charge you. So next video, we're going to be looking at how does that then, the bill then affect us as borrowers. So stay tuned, please share the videos, subscribe so that you stay tuned and know what's going on. And yes, I have released a book, so please click on that video, and I was at this side, I'm not too sure. And you'll get to know more details on when we're going to release it. So God bless you, and I wish you all the best. This is MoneyWise with Rina Hicks, where we create, grow and preserve wealth.